Hey YouTube, Jason here with Day Trading Fearless. Welcome back to my channel. If you're new, welcome. Make sure you guys hit the like button and also subscribe. And all these option videos are sponsored by myself. So these are the weekly trade zones for the S&P Emini futures. $50 one-time payment for a lifetime subscription. I've been doing these for about 7 or 8 years now. And every weekend I send you all these trade levels. Again, $50 only. Go to daytradingfearless.com or click the link down below in the description. And also make sure you check out my Patreon page at patreon.com/daytradingfearless to follow along with my trading portfolio. So, with that being said, let's jump into the option video course, and I hope you guys enjoy it. And thank you for watching. Okay, welcome back. Into today's video, we're going to talk about implied volatility. Okay, what is IV? Okay, so let's jump right into it. Implied volatility, IV in short, is a big part of options. Think of IV as premium that is either added to or taken away from the fair price of an option. An example is XYZ stock is trading at $20 and the October 20 call options with 30 days left are trading for $1. And the implied volatility is currently at 25%. Now, when we look at a option, okay, over here on Thinkorswim, you see this is what the IV is. This is the IV, right? So right now with 30 days out, we have a 66% option, IV. Okay, so that's the implied volatility. Now, is that high or low for this? Well, it's relative to itself, right? Now, we'll speak about IV rank, and when we start to talk about IV rank in another video, then you'll be able to tell if this is either expensive or if it's cheap, right? So, but all for this is that we have a 66% IV, right? So if the IV rank goes up, options are going to get more expensive. If IV goes down, the options are going to become less expensive. And it's only on the premium side, which is the extrinsic value, right, of it. So now, XYZ just came out and said they will be making a news announcement, okay, after the stock market closes today. Nobody knows if the news is going to be good or bad. So the option makers raise the implied volatility of the option, which in return raises the price of the options, aka also known as adds premium to the option price. As IV has spiked due to the news, the stock is still trading at $20, but the October 20 call options with the same 30 days left are now trading for $2.25. And the IV has moved from, we'll say, 25% to 70%. Okay, these numbers are a little skewed, right? But just so you understand, right? So essentially what happened was XYZ stock is coming out with they came out with a news release, press release that they're coming out later on today with some news. We don't know if that news is good or bad. So the option maker has to hedge himself. So what he'll do is he'll go and move up the implied volatility that was currently at 25 all the way to 70%, right? Well, the stock never really moved, right? Because we're still at $20. But if you see, because of the move of implied volatility, there has now been 25 cents added risk into that option. Another really probably simple way to think about this is, let's say you go get car insurance, okay? And for the 6 months, it's $1,000 for the 6 months for your car, right? You're a great driver, all that. Well, all of a sudden you get into a car accident. Well, when it comes time to renew, you are now more of a risk because you got into a car accident during that time period. So now you're going to pay $1,250. You drive the same amount of miles, all the things are still same, the coverage is all the same, but you're just now a higher risk. Okay, now if you could drive an entire year without having a car accident, okay, then they're going to say, okay, hey, let's drop his IV back down to 25%, or let's drop it back down to $1,000 because he's no longer a risk. So that's a simple way of looking at it. So now, once the news has come out, the stock price did not move as anticipated, okay, and has remained at $20. The price of the call option has gone back down to $1, while the IV went back to 25%. So nothing happened. It was just they just wanted to come out and say everybody's still working with the company, whatever the news release is, right? And so it didn't move the stock. Nothing happened. So the market maker takes that 25% back out. Kind of going back, you drove good for a year after a car accident. They're going to bring your rate back down to 1,000. So for the 6 months. So now the VIX, which is also known as the fear gauge, is a product that tracks the S&P 500, okay, and aka the SPX. When traders start buying puts, that will move the VIX higher, which in return makes IV start to rise, which then makes options more expensive. So the VIX is a implied volatility product, right? It's something you can actually trade. ETNs or ETFs of it are VXX, right? TVIX, things like that, where you could bet on implied volatility going up or down. But the way the VIX really works and the way you look at the VIX is it is a fear gauge, okay? And when the big boys start buying puts in the VIX, okay, then usually the VIX will start to rise. When they start to close those positions and buy calls or things, or don't do anything and just close positions, then the VIX will start to go lower. And that's how implied volatility is really vibrates throughout the whole market, because if you're a market maker and you just see the VIX start to rise, meaning, hey, there's a lot of puts, somebody knows something potentially, then they're going to start to raise the implied volatility because the VIX is starting to rise. So I hope that makes sense. A simple guideline for tracking the VIX is that a low VIX is between 10 to 15, and a high VIX will be around 25 to 40. Anything above 40 is very extreme in the world of the VIX. Just type in VIX on your trading platform to see where the VIX is currently trading. And then that will really help you to understand, are we in a high volatility or low volatility, right? Because higher the volatility, more expensive options are. Lower the volatility, the less expensive those options are. As you see the VIX rise or fall, you will know that option pricing should follow the same direction and also rise or fall with the VIX. When the S&P 500 moves, the VIX should move inverse to it. So if the S&P moves up, the VIX should be moving lower. Now, there are times where you could see the VIX fall, but option pricing on a specific stock may actually start to move up. That's because there's other things going on stock specific with that one stock. So just keep that in mind. So finally, think of IV as a fear gauge. When there is uncertainty, the IV will rise, and when the news is out, good or bad, the IV will get crushed or go back lower. Okay, so that's a really simple, basic way of really understanding implied volatility with options. So I hope this video helps, and thank you for watching.